I believe the Federal Reserve is about to make a big mistake, and not a mistake that's going to crash the stock market or anything. It's actually a mistake that I think is going to make the stock market soar higher for longer, which is great as investors in the stock market. We want to make money, and that basically guarantees we're going to make money. But the problem is when the bubble eventually pops, which is inevitable, or the market melts up, turns into a market meltdown. You see, right now we have what's called the Fed put active. The Fed put basically just means that the Federal Reserve is willing to do anything and everything under its power to avoid a recession at all costs. This is a great thing for the economy and the stock market because it pulls risk out of the system. It provides a sort of backbone to both the economy and the stock market. But the Federal Reserve board members, they're also human, and humans tend to make mistakes. And the Federal Reserve tends to make policy decisions based off of short-term aberrations in data. The closest example just happened a few weeks ago when all of a sudden the Federal Reserve decided to cut interest rates by 50 basis points because we had a short-term aberration in the labor market data. Initial unemployment claims soared, the unemployment rate ticked higher, and the Federal Reserve thought we were in trouble because on the surface level it looked concerning. They failed to dive deeper into the data and realized that it was just a short-term aberration caused by Hurricane Beryl that caused a lot of people to file for unemployment. And what do you know? Ever since then, the employment data has been very strong. So the Federal Reserve has arguably lost some credibility just over the past couple of weeks. And I'm concerned that they're about to make the same mistake. I just got done reading through the Federal Reserve's minutes from their September meeting, and there's one line in here that kind of repeats itself several times. I highlighted it once, and I'll put it up on the screen. It says, almost all participants agreed that the upside risks to inflation had diminished. This is a little bit bass-ackwards to me and confusing and concerning. It wasn't that long ago that Powell called supercore inflation, quote, possibly the most important category for understanding the future evolution of core inflation. But since he made that claim, he's kind of gone quiet on it. And it's because that supercore inflation is showing signs of extreme stickiness. And he used to call this a great indicator of future inflation. And in the Federal Reserve's minutes, they say that they agree that upside risks to inflation have diminished. Something there doesn't add up. I'm no mathematician, but the super core inflation rate, which is just CPI services less housing, so excluding housing data, it ticked up in the month of September from 4.3% to 4.4%. And if we look at the super core inflation data, it's a far cry from this, quote, mission accomplished that this current Federal Reserve has tried to claim by cutting interest rates by 50 basis points. And we also need to remember, when it comes to the disinflation we've seen in the data, most of it has come via a decline in energy prices and a decline in goods prices as a result of the Chinese economy trying to export their way out of recession over there. They're exporting deflation directly into our economy. That is seen in the data everywhere, and that's that's the major cause of the goods deflation we've seen. In the month of September, energy prices fell 6.8% year over year in the CPI data, and goods prices fell 1.3% year over year in September. So what's the problem with that? There's no problem with it, but the problem could be that those two things don't stick with us forever. We're not going to have energy prices continue to come down, and eventually the Chinese economy will recover to a point where goods prices no longer are deflating. And what happens if oil prices decide to go back up throughout the balance of this year? And what happens if the Chinese economy does recover? And what happens if, as a result of the weaker dollar and these port strikes and these unionized workers seeing wage price gains, what happens if goods prices decide to go back up into year end? Well, very easily, the headline CPI rate could be inflationary again. It could stop coming down and actually start to go back up. So this is where I'm confused. How do we say that the upside risks to inflation have diminished when all of these things are true. And I know all of you watching this video have seen it. There is a lot of geopolitical tensions overseas right now. And that is just a catalyst waiting to explode the price of oil. Now, when it comes to initial unemployment claims in the labor market, I think we're going to see the same exact playbook play out. And we've already seen how the Federal Reserve reacted the first time that this happened. Just over the past couple of weeks, we've already had 2 new hurricanes make landfall. And as a result of that, the initial unemployment claims data showed a significant uptick in initial unemployment claims as a result of primarily that first hurricane that made landfall and partially that port strike that occurred. People filed for unemployment. There's 3 states, the United States of America, that allow striking workers to claim or file for unemployment. New York, New Jersey, and California. I think it's the second largest port is the New York, New Jersey port. That's a lot of workers that were able to file for unemployment. And I don't think we've seen all of that hit the data yet. And then you stack on top of that another hurricane that was even more destructive that made landfall. And I just think, October's employment data is going to look soft again, but it's going to be because of these short-term aberrations or events that are irregular. At least you hope they're irregular and they don't keep repeating themselves. As horrific as these hurricanes have been, if you want to speak more economically about it, in the medium term, it's actually going to cause an increase in jobs because of all the rebuilding that has to take place. But that also means that it's also an inflationary event, all of the rebuilding that takes place. That's another inflationary catalyst. And I haven't even gotten into asset prices being at all-time highs. I haven't gotten into the Treasury Department also stimulating the economy by borrowing short-term money to buy back long-term debt, which holds long-term interest rates lower, which is stimulative to the economy. I haven't even mentioned our future president, that no matter who it is going to widen the federal budget deficit, which is stimulative to the economy. Yet all of these things are also inflationary. These things bring upside risks to inflation with them, yet we have a Federal Reserve right now that thinks that the upside risks to inflation have diminished. It makes zero sense to me. So we have a time period again where the labor market is going to look weak, yet the Federal Reserve is failing to recognize that the upside risks to inflation are probably higher than they have been in a long time. And that formula, based on what we know the Fed has already done, starts to paint the picture of a Federal Reserve that continues to cut interest rates much more than is needed right now. We look at corporate profit margins at all-time highs. Again, asset prices at all-time highs. Any data you look at, it'll show you that the federal funds rate for the economy as a whole is not restrictive, despite what the Federal Reserve is telling us. Sure, there's pockets of the economy, particularly the most interest rate sensitive pockets of the economy that are feeling pain, that are feeling restrictiveness from the federal funds rate. But as a whole, the economy is on very strong footing right now. And the federal funds rate being at 5% is not the abnormality historically. The abnormality is the free money policy that we've seen since the great financial crisis in 2008 and 2009. And we look at money market mutual funds. Every single day, it seems like the stock market sets a new all-time high, new all-time high, new all-time high, yet money and money market mutual funds continues to also set new all-time highs. And you just have to think, okay, if interest rates continue to come down, a lot of this money that has gone into money market mutual funds over the past few years with interest rates being higher, it's going to move out of risk-free yields as risk-free yields come down, and it's going to come back into the stock market. And you start to wonder, you start to wonder what the melt-up in stock prices could really look like if interest rates continue to come down. And I've kind of been painting this picture on the YouTube channel for a few weeks now that I really worry that the Federal Reserve is going to overstimulate this economy. It's going to overheat, and we're going to see a stock market melt up, which is a good thing for us investors because we can make a lot of money in a short amount of time. But the pain does come when the bubble pops and the market melt up turns into a market meltdown because it's painful. It's painful. And if this bull market ends up making the 2021 bull market look small, whatever bear market follows this bull market is going to make the 2022 bear market look small. I mean, this could be very painful stuff. Now, we've been kicking the market's butt since late 2022. On the screen here, it just shows you over the past year how my portfolio has performed, how we have done on this YouTube channel. Our return has been 121% over the last 12 months, which is almost 4x the performance of the NASDAQ. If you've been following my channel for a while, you know that we have had extreme success. It might mean that we're due for a little bit of correction here, but I just wanted to show you this. If you want extra access to what I'm thinking, along with a bunch of other perks, and you get to support me, I'm entirely independent and self-funded. Just the fact you're watching this video this late into the video means a lot to me, but if you want to take that extra step, I would encourage you to join the paid monthly membership. If things keep going the way they're going, you're going to see basically immediate return on investment here. And I also have a 100% refund policy. That's how confident I am in my ability to give you good research and analysis on the stock market and the economy. And if it's not for you, again, I refund you 100%. I've yet to have to refund anybody. So you should let that speak for itself. We're approaching around 200 members in the Discord server. So that's really exciting. And I'd love to get there before the end of this month. So help me out with that, if you will. It means a lot to me, your support monthly. But thanks for just watching this video. Now, where do I think the next phase of the stock market will go? Well, if we look at gold prices, and if we look at, I'll pull it up on the screen. If we look at small caps are having a great day today, up 2%. But small caps are the only sector of the stock market that have yet to reclaim all-time highs and go significantly above those prior all-time highs. And again, we can look at the price of gold being at an all-time high, and it tells me that despite the NASDAQ having great return over the past year, actually over the past couple of years, risk on really still hasn't come back to the markets. And if the Federal Reserve does choose to overstimulate and they fail to see these short-term aberrations in the data and they continue to cut rates aggressively, you're going to see a market melt up. And all of this money that's flooding into the system from all of this stimulus, and you have to remember, it's not just our country that's stimulating, it's all of these other countries around the world that are stimulating their economies that ultimately end up benefiting our economy too. We're trying to drink from the global monetary stimulus fire hose, and it's impossible to do. There's a lot of excess that's going to form, and I think risk on is going to come back in an aggressive fashion. I've mentioned a few companies on my YouTube channel recently that I think are going to benefit from this trend tremendously. We have Bitcoin. I have a lot of Bitcoin exposure right now. I also just the other day mentioned that I think it's time to start buying CleanSpark stock again. And that's a Bitcoin mining stock. That's as risk on as you're going to get in the markets. And if risk on does return and euphoria does return, it's going to be companies like CleanSpark that actually do the best. But I also have One Stop Systems and I have Flux Power. I've owned PayPal. Despite the NASDAQ performing really well, again, there have been great opportunities out there, buying opportunities out there. And I invest like a farmer. I keep saying this, but I think it's a great analogy. You know, I'm a fourth generation farmer, and if my crops outside aren't growing as fast as I think they should grow, I don't go out there. I don't yell at them to grow faster. I don't get angry with them. I don't uproot them. And I also don't uproot them before they've had a chance to produce something for me. On this YouTube channel, a lot of the reason we've outperformed the markets historically is because we are early to trends, which means short term we might be down on money, but long term we beat the markets because we're not a part of the flock that just flocks to whatever's hot, flocks to whatever's popular. Because if you're a part of that flock, you're just going to match the market performance or you're going to underperform the market performance, which is not what you want if you are an individual stock picker. So a lot of my strategy is beating everybody else to what I think is going to be the next trend in the markets. And we've had great success with this. It takes an immense amount of patience. People are going to call you dumb. They're going to call you stupid. They're going to laugh at you if you underperform short term. But I have learned that why do I care? Long term, my performance speaks for itself, so I'm not going to change that blueprint. But all of that set aside, the last thing I want to leave you with in this video is real GDP. Super exciting, I know. But again, this ties the whole video together. The Federal Reserve is worried about the labor market and the economy, and they're not worried about inflation. Yet, our GDP growth is above average right now. In Q3, it's estimated that GDP is growing at 3.2%, which is above average. And it also means that our GDP as a country continues to set new record highs, new all-time highs, which again, how does that indicate to us that the federal funds rate is restrictive at all? The answer is it doesn't. If the federal funds rate was truly restrictive, our GDP would suffer. The labor market would suffer. Corporate profit margins would suffer. And those things they're not happening. Now, on the other hand, let's say the Federal Reserve has learned from recent weeks and they see through these short-term aberrations in the data caused by the port strikes and the hurricanes or just different weather events. Let's say they recognize it this time and they choose not to cut interest rates aggressively. Well, that's also good news for us bulls in the stock market. The easiest path forward is for stock prices to continue to go higher and higher and higher. I don't see anything getting in the way of that. And geopolitical tensions, we talk about how they're heightened right now. Well, if you look at any chart, most of the time, outside of the 1970s, any sort of geopolitical tensions have just been tremendous buying opportunities in the stock market. They have very rarely led to long-term bear markets. Very rarely has that happened. So, and that's the biggest bearish catalyst that I see short-term for the markets that could uproot this rally we've seen. So I think the path forward is stock prices continue to climb higher. It's just a matter of how aggressively it happens. And what's going to determine that is the federal funds rate and how quickly the Federal Reserve decides to cut interest rates. But on this YouTube channel, we're going to keep track of all of this data. So if you enjoyed this video, you're going to like all the future videos that I put out, and you can go back and watch my most recent videos as well, and you're going to enjoy those. Make sure you subscribe if you're new here or returning and not yet subscribed. We have one of the fastest growing stock market YouTube channels on this platform, and I am biased, I admit, but I would like to continue that trend. But I think it's for good reason. And hopefully our success continues. Obviously, there's no guarantee. I don't have a crystal ball, and I will be wrong in the future. I'm not perfect. Nobody is. And just like every other person that exists, I will make mistakes. That's a given. We just want to be right more than we're wrong. And so far, so good when it comes to that strategy. Anyways, I hope you have a great weekend. I tried to keep this video a little bit shorter for you. Have a great weekend. Stay blessed. Count your blessings every single day. Every breath you get is another gift in life. So take advantage of every second of every day. Go impact somebody's day in a positive way today. Have a great rest of your weekend. Stay blessed. Keep 10 toes ground your chin up. Peace out.